All right, so Prospect Capital's first quarter earnings for 2026 just hit the wires, and boy, did the market notice. Now, if you follow this space, you know PSEC. It's that super high yield BDC with let's call it a controversial track record. So let's get right into it and figure out what these numbers are really telling us. I mean, right out of the gate, the market absolutely loved what it saw, at least at first. The stock shot up 7.5% on the day of the call. Now, you got to remember, for a stock that's been in a pretty deep downtrend, a single day move like that, well, it's a big deal. It forces us to ask a really critical question.
So here's the big question on everyone's mind. Is this the start of a real, genuine turnaround that the bulls have been waiting for? Or is it just another dead cat bounce, a flicker of hope in what might be a classic high-yield value trap? Well, to figure that out, we've got to get our hands dirty and dive into the numbers.
Okay, first up, the Q1 earnings by the numbers. And really, this is a story of beats and misses. The results were a very mixed bag. And honestly, that's exactly why this stock is so heavily debated. You can find something in this report to support just about any argument you want to make.
Okay, so let's break this down. The headline number, the one that really got everyone excited, was the net investment income per share, or NII. They posted 17 cents a share when the consensus was looking for just 11. I mean, that's a massive 55% beat, and that's what drove the stock higher. It also means that big dividend is covered by about 126%, so it looks pretty safe for now. But, and you knew there was a but, revenue actually missed expectations. And even more concerning, the net asset value per share, the book value, it kept on falling. We're talking down 20% from this time last year. Ouch. So here it is, the good versus the bad, all on one slide. This really paints the picture. In the good column, you've got that massive NII beat, which means earnings power surprised everyone. The dividend coverage is strong, so that huge yield is covered. And the quality of those earnings improved too, with less non-cash income. But then you look at the bad column. Top-line revenue growth is lagging. The book value continues to fall apart, down 20% in a year. And despite the one-day pop, the stock's performance has been abysmal, down over 40% in the last 12 months. So what's management's grand plan to fix this mess? Okay, on to management's game plan, the great portfolio pivot. They spent a ton of time on the earnings call talking about how they're repositioning for higher yields. This isn't just a minor adjustment. They are making a very deliberate, very aggressive shift in their investment portfolio. The idea is to fundamentally change the risk and return profile of the entire company. And you can really see just how dramatic this pivot is. Since just last June, look at the change in what they own. They've jacked up their exposure to first-lien loans by over 700 basis points. At the same time, they've absolutely slashed their holdings of riskier subordinated notes, down by over 800 basis points. So they are swapping out risky stuff for safer senior secured debt. This isn't a small tweak, folks. It's a major strategic shift. So here's the game plan in 3 simple steps. First, they're getting out of real estate, selling off properties for a cool $59 million at a really impressive 23% IRR. That unlocks a lot of capital. Step 2 is all about reducing risk. They've cut those subordinated structured notes, the really risky stuff, down to basically nothing, just 0.3% of the whole portfolio. And then, step 3, they take all that cash and redeploy it. They're targeting 15% plus yields by making first-lien loans to lower middle market companies. This is the core strategy they hope will finally stabilize that book value and grow earnings.
Now, this brings us to the deep discount dilemma. I mean, the strategy sounds pretty good, right? You de-risk the portfolio, you sell assets at a profit, and you reinvest that money into higher-yielding loans. The problem is, the market remains deeply, deeply skeptical. For whatever reason, it just isn't buying the turnaround story yet. And this chart right here, this says it all. Your average BDC trades at right around 1 times its net asset value, par. But look at Prospect Capital. It's trading at around 0.3 times NAV. That means you can buy $1 worth of their assets for just 30 cents. That is a massive, massive 70% discount. This isn't just a small gap, it's a chasm, and it shows a profound lack of trust from the market. Of course, when the bulls see that kind of discount, their eyes light up. You see commentary popping up, like this one from Seeking Alpha, calling it a strong buy. And the argument makes sense on the surface, right? You've got a 60% discount to NAV, you've got insiders buying their own stock, and you have a portfolio mix that is clearly improving. That looks like a classic deep value play. But then you look at the other side of the coin.
the sell-side view. The professional analysts are having none of it. The average rating is a sell, with a price target down around $2.50. Firms like Wells Fargo are saying, look, we are skeptical that the NAV erosion and underperformance are truly behind this company. They basically believe that massive discount is there for a very, very good reason.
Okay, so that brings us to the big finish, the next call. Time to weigh all the risks and the rewards. We've seen the conflicting numbers, we've seen the strategic pivot, and we've seen that huge valuation dilemma. So what's our take? What's the trade here?
First things first, we have to talk about the primary risk here, which is the dreaded value trap. What is that? Well, it's a stock that looks really, really cheap based on all the valuation metrics, but it's a trap because it just keeps falling or going nowhere as the underlying value of the company continues to erode. It's the ultimate nightmare for a value investor.
Okay, so let's quickly recap the bull case. Why would you buy this stock? Well, first, that 60 to 70% discount to NAV gives you a huge margin of safety. Second, you've got insider buying, which signals that management has conviction. Third, that portfolio rotation into high-yielding loans could finally stabilize and grow earnings. They're also unlocking capital from real estate sales at great returns. And finally, credit quality, for now, looks stable, with non-accruals at a very low 0.7%.
But the bear case, well, it's pretty powerful, and it's rooted in a long history of underperformance. The chronic NAV erosion has been destroying shareholder value for years. This isn't a new problem. That deep discount, it's not there by accident. It reflects a fundamental lack of trust in management. And you have to consider the broader environment. The private credit sector is facing some headwinds. Any real rise in defaults could just accelerate that NAV decline. Really, the past performance here screams value trap.
So here's our final verdict, the next call. We're rating the stock market perform. The thesis is this: the portfolio pivot is absolutely promising. It's the right move. But one good quarter doesn't erase years of NAV decline. That discount is going to stay until management proves they can stabilize the book value for multiple quarters. So what's the trade? Our take is to own the new 5.5% 2030 unsecured notes for income, not the common equity for appreciation. You sidestep the biggest risk, that NAV erosion, while still collecting a decent yield.
And of course, we always have to end with this reminder. This analysis is for informational purposes only. This is not financial advice. Please be sure to do your own research before making any investment decisions.